uh, to ask some questions, especially on the tax-related matters. Passing it on now to Mark.
Hi. Thank you for having us. Is Charu in the chat? I don't see her.
Hi, Mark. I'm here. Hi, everyone.
Okay. Go ahead, Charu.
Hi, everyone. Good evening and good morning, different time zones that we're in. So my name is Charu. I work as a wealth manager with MASECO Asia. I've been with the firm since 2023. So what we'll do is we'll start off with a brief introduction. I'll give a brief introduction of MASECO, what we do, and and then we'll move forward. So like I said, my name is Charu Mathur. I am a wealth manager with MASECO Asia, been with the firm since 2023. I have my academic background in economics, later an MBA in finance, after which I worked with different banks and financial institutions in Delhi, Singapore, and Hong Kong. I've been a strong advocate of women's financial empowerment and professional advancement. I frequently engage in mentoring programs, panel discussions, initiatives that encourage education and knowledge sharing while fostering diversity in finance. So I'll give a brief background of MASECO, who we are. So we are a Type 9 licensed asset management firm regulated by the SFC in Hong Kong, registered with the SEC in the US. We are a fee-based advisory, and we provide discretionary investment advisory services to address the financial planning and tax-efficient investment planning needs of US-connected people and global citizens. MASECO brand was founded in 2008 in the wake of the introduction of non-domicile tax rules, and the two co-founders of the company who had their backgrounds at the American expat desk of Citibank and Solomon Smith Barney, they decided to found MASECO to look after the wealth management needs of American expatriates living in UK and Europe. We've grown, we've diversified since then. We came into Hong Kong in 2016. So between London and our Hong Kong office, we manage about $5 billion US dollars plus of assets under management, employee strength of about 125 people, and we work with around 650 to 700 individuals and households. Within our investment portfolios at MASECO, we focus very strongly on global diversification and low costs, and the usage of ETFs allows us to achieve these objectives. Now, before we delve into the global macro update, I'd like to take you quickly through MASECO's investment philosophy, why we do what we do within our portfolio construction. Now, this will help to lay the foundation of the investment rationale that we have, and then we can move to the macro update. Could I move to the next slide, please? Thank you. Yeah. So our investment rationale, our fundamental beliefs are based on very strong academic research with empirical evidence backing it. And we have the work of a lot of Nobel laureates that is reflected in our investment philosophy. So what you see here in the bubble chart are the investment beliefs. The first one here, risk is rewarded in the long run. Now, long run means different things, different timelines. So from an academic standpoint, a long run would be 20 plus years. From an institutional standpoint, it would be about 15 plus years. From a retail standpoint, which is where investors like you and I would be there, we essentially talk about 6 to 7 years. So what we ask is, when we think of long term, think at least 6 to 7 years. Stock picking doesn't pay. So picking stock A over stock B, maybe picking Tesla over Chrysler, picking a Ford over GM may work once, may work twice, but in the longer scheme of things, it's essentially looking at the broader range, the universe, and which is where also your global diversification will come into play, and we'll talk about it as we move along. Time in the market, not timing in the market. I'm going to talk about it in the next slide. Diversification reduces portfolio risk. So at MASECO, we are very strong advocates of global diversification. Typically in our client portfolios, The clients would have exposure to about 50 investable countries and 16,000 underlying positions. So that's the extent of diversification when we say diversification. Asset allocation is critical. Now, asset allocation essentially means how your portfolio is divided between different asset classes. So, equities, fixed income, cash, and cash equivalents, and how the strategy balances risk and reward by aligning long term objectives and risk tolerance. There are many, many studies that prove that asset allocation is one of the critical, is one of the fundamental starting points within a person's portfolio to determine the long-term objectives. Small value profitability premium. Now, these essentially are so at MASECO, within our portfolio construction, we follow something which is called factor investing. Now, what essentially that means is factors are characteristics in stocks that can be targeted to increase the potential of an upside, to increase the potential of an above market return. So what we look at within our portfolios would be small cap, value, and profitability. And I'll briefly explain this as we move along. Now, small cap stocks are typically companies that have a market cap of about 250 million to 3 billion. These are smaller growth-oriented firms. Now, unlike large cap stocks that have analysts working round the clock on their stock movements, small cap stocks typically do not have those. So any upside has a higher chance of moving the needle positively for these companies. Now, there are many studies that have shown that small caps have outperformed large caps over long periods of time. Value stocks. Now, value stocks are publicly traded companies that trade for cheaper valuations relative to their earnings and long-term potential. Now, this is as opposed to growth stocks that are anticipated to grow at a rate significantly higher than the average growth rate of the market. Value stocks are companies that that focus on paying dividends, that focus on growing net revenue. So companies names such as Berkshire Hathaway, Procter and Gamble. These are companies that fall into this segment. There is strong data to show that value stocks have outperformed growth stocks over long periods of time. Profitability essentially refers to profitability per dollar of sale. So if stock A has a higher profitability per dollar of sale as opposed to stock B, the high PE stock will have an overweight in MASECO portfolios. So small value and high profitability stocks have an overweight or a tilt in our portfolios. Basically, what this means is we are overweight or we have a tilt in our portfolios towards these stocks. Having said that, you will continue to see the remainder of the universe, of the investable universe in our portfolios. Tax efficiency and costs. Now, we ensure that our portfolios are tax efficient so that taxes do not eat into the portfolio returns. Similarly, costs such as fund manager costs, expense ratios, etc. They are kept to the minimum so that they do not impact any kind of portfolio returns. Total transparency, again, one of the things that we focus on within MASECO portfolios. Rebalancing. Now, rebalancing essentially means bringing the portfolio back to its certain risk level. Typically, what would happen is the equity component of the portfolio will outperform the fixed income component over a period of time, and which is how it's supposed to be typically. So it's important to bring the portfolio back to its certain risk level to avoid the risk drift. We do rebalancing twice every year, once in March, once in September. So these are the fundamental beliefs that we build our portfolios on. Could I move to the next slide, please? So the previous slide had this bubble that talked about time in the market and not timing the market. So this is what we mean. What you see here through this bar chart is what happens if you were to miss a couple of days or a week or couple of weeks within your portfolios, if you were to miss these in the market. Now, typically in a year, there are about 235 trading days, out of which there would be 45 to 55 best days that help you achieve the upside. However, absolutely nobody would have that crystal ball to tell what those best days are. Hence, it's advisable to stay invested in the market. And what you see here through the bar chart is what happens if you were to miss a week, a month, 3 months, or 6 months, and how that would impact your overall performance of the portfolio. Next slide, please. We talked about diversification in the previous slide and how at MASECO we focus a lot on global diversification. This is what is called a quilt chart. So what you see here are indexes, different indexes, both on the equity side and the fixed income side. And what this chart essentially shows is there is literally no pattern. And that's essentially what that means, because nobody will know which markets will outperform from year to year. So by holding a globally diversified portfolio, you position yourself to capture the returns wherever they occur. So rather than trying to pick the needle in the haystack, we essentially would look at the entire haystack. Next slide, please. All right, so what we want to show here through this slide is behavioral finance, and behavioral finance is an integral part in the investing world. Behavioral finance essentially looks at how our biases and emotions have an impact on our decision making. So the bell curve that you see here, think of it as a roller coaster of emotions that one would go through every time, anytime there is a market upheaval. So let's say if we were to take the example of COVID 2020, and its impact that it had on the markets. So February of 2020, when the market started to go down a little, investors had their emotions ranging from indifference to concern and somewhere between fear and panic. When they thought the markets would probably not recover, they were extremely unsure of how things would move forward. Somewhere between fear and panic, they decided to sell their positions and get out of the market. However, as it is with every market event, and as history has shown us as well, typically market events, the recovery timeline is anywhere between 12 to 18 months. Markets do eventually recover and continue to move in an upward trajectory. The same thing happened, and the same investors that had exited their positions re-entered the market along this curve here when their emotions, when they started to feel a little more positive. However, what typically happens is in the process of exiting and re-entering, investors enter something which is called a wealth destruction cycle. Important to understand here that there are two kinds of losses. One is a paper loss, which is only on paper. The other is a realized loss, which is the loss that you decide to take by making a sale. So our job as wealth managers at MASECO is to keep investors away from making decisions that will have a negative impact on their portfolios over the long run. And we work with our clients to ensure that there is a long-term plan and we stay disciplined to that plan. Tune out the noise that's there in the market and stay disciplined. Next slide, please. Okay. So to sum up our investment philosophy, we end with a similar bubble chart that we had started with. So what do we do as wealth managers at MASECO? We create an investment plan for you, which is a blueprint of the financial planning and the tax efficient investment planning for you. We think long term. So like we discussed, long term from a retail perspective, 6 to 7 years plus. We overweight investment premia, so small value and high profitability companies. We diversify globally. 50 investable countries, 16,000 underlying positions. We manage costs and taxes for you. We rebalance to manage risk, so every March and every September, and we stay disciplined. So, this is our investment philosophy. The reason why we thought we'd share this with you is when we now move to the macro update, the investment philosophy helps to lay the foundation of how MASECO works on investment portfolios, and a lot of terminology that we are going to use now, it'll help to clarify a lot of things. So, if I could ask Mark to start with the macro update now. Next slide, please. Thank you.
Okay, thank you very much. If we can move to the next slide, please. One after that. So this is a little background of what took place over since the start of the year. Just to give you some background, 2025 was a fantastic year for equities. Globally, equities did nearly 22% in 2025. US did 17%, which is outstanding, but it lagged the rest of the world in that the developed market ex-US did about 32%, whereas emerging markets did about 34%. That was the first year since 2010 that the rest of the world outperformed the US. And the start of 2026 was very similar in that the rest of the world was outperforming the US until the start of the Iran conflict. Since then, we've seen global equities up about 11% at the end of July, and through the end of last week, they're up about 14%. So it's been another great year for equities. Also, in 2025, we had a very good year for fixed income, where they ended up the year around 6%, which is outstanding. And it started this year the same way again until the start of the Iran conflict. Then things turned around a bit. One of the reasons that people, I guess, don't understand why the market's doing so well with such a background of wars, two of them still ongoing, tariffs and things of that nature. Why is the market done so well? That's because of earnings. Earnings have been beating estimates every single quarter. And this year, they're up about 24% year on year, which is pretty outstanding. It's unusual, and this is almost a 2 standard deviation event, but that's what we've been seeing. In Asia, we've had two areas, both Taiwan and Korea, that have been outperforming. In particular, about 3 different companies have been outperforming the rest of emerging markets. And if you think about it, if emerging market index was a value-weighted or a value-weighted index, we would have Korea and Taiwan being almost 40% of the index because of the AI companies involved there. Fixed income, as I mentioned, had a great year in 2025. This year it's been far more muted, although we do still have a positive return. And I think that one of the things that has come out over the past, call it 18 months now, is that the investment grade credit market has remained very healthy. And we've seen that the spreads have been multi-decade lows, meaning that investors are very optimistic about the economy. And that is, again, on the backdrop of outstanding earnings calls. Now, as Charu mentioned earlier, we at MASECO have a slant in our portfolios to small caps and value companies, as well as profitability. But those slants have done exceptionally well and continue to do very well this year. And in fact, value has been outperforming growth in 2026. Can we move to the next slide, please? Continuing on, I mentioned that we've had the Iran conflict. And while tensions seem to be easing, it's anyone's call at this point. It's been on again, off again. It's usually bombing on Friday and making amends on Sunday. And that's what we've been seeing with the markets. It tanks, then it comes back, and there's been some insider trading in this administration, as I think we've seen through news reports. GDP is currently sitting around 1.8%. Last quarter was pretty abysmal at 1.5, but because of the stronger first quarter prior to the start of the conflict in Feb, we had better growth in the U.S. What we've been seeing across the world is that most countries at the start of 2026 were looking to cut rates. But what we've seen is basically the opposite, is that a lot of the countries have looked to raise them, including the U.S. And the U.S. is basically inflating at a higher level than just about anywhere else in the world. And that is due in part to Iran, as well as the tariffs that have been put in place. What we've seen anecdotally is food prices in the U.S. have gone through the roof, and unlike rest of the world, they have not eased since the end of the COVID crisis. What we've seen is they've remained elevated, and that I can tell you personally. I just came back from the U.S. in the greater Detroit area, and food prices there are high or higher than here in Hong Kong. So, which is unusual, and I don't think it's sustainable, because at some point that's going to leach into people's expenditures, and what they'll basically do, and what we've been seeing, is cutting back. However, we do believe, because we are investors, that you should really focus on the things that matter. And in this case, it's the fundamentals of companies' earnings, and they have been very strong. And so that's why we've continued to see the markets continue to rise. Can I go to the next slide, please? So here we're taking a look at daily tanker traffic through the Straits of Hormuz. You can see the start of the war here on the left-hand side. And what we saw was a dramatic drop-off. And the fits and starts that we see throughout the rest of the panel on the left-hand side is just what I was referring to, is when he said that the war is ending, or we're going into negotiations. You see a spike in traffic, then you see a comeback or a letdown after it's decided that clearly nothing's happening. On the right-hand side, we see WTI and Brent. WTI is West Texas Intermediary. This is just oil prices. Brent tends to be more expensive than WTI over the long term. And what we see again is the rise when war is on, and the fall when war is off. And what we've seen over the past few days, especially after this past weekend, was that they decided not to do an increased bombing, or the U.S. decided not to do increased bombing, and said we were going to go to the negotiation table, and that's why you see the fall off. We could go to the next slide, please. Here you're taking a look at what has taken place in terms of the dollar. The dollar in basically from 2020 through 2024 increased against the market basket of currencies globally. And what that means is goods and services are more expensive for the U.S. to export. And so that's why we have seen a turnaround of countries around the world that have been beating earnings in the U.S. because of that reason. What we see here is the fall off of the dollar against the market basket on the right-hand side. You can see some of the more important points here, where Warsh was appointed to the Fed and became the chairman. One of the things that came out of his first speech was that he tended to be a bit more hawkish than expected, especially what Trump wanted. Trump wanted someone to go in there and cut rates immediately. And unfortunately for him, Warsh is just one of the many votes on the Federal Open Market Committee, and so he can't actually control what happens to rates. That's a consensus. We can move to the next slide, please. Wade, is that a question I should answer now? Okay, yeah, let me just take a look at that chat again. What is MASECO's view on Fed interest rate decisions for the upcoming last half of the year? My guess is we will see interest rate hikes. Inflation remains sticky and high. Their band is basically 2%. We've been sitting well above the 2% range for some time. We're currently about 2.8% on the rates chart. And so I don't see any reason at this point in time that there'll be a rate cut. And I think we will see a rate increase. And the expectations, according to the dot plot, which is something that comes out after each meeting of the Federal Open Market Committee, shows that the likelihood is that we will have 2 rate increases by the end of 2026. This one is taking a look at inflation swaps. This is just nothing more. Inflation swaps are a nothing more than a contract, and they're traded excuse me, at the exchanges, and it's simply saying that one person thinks interest rates will be here, the other person thinks they'll be there, and they make a trade. And what we're seeing is that while we've seen a tick down recently of interest rate expectations or inflation expectations, it still remains elevated. And that's why I believe that if you take a look on the right-hand side, the black bars are at the start of 2026. That's what the expectations were for rates. And what we see on the blue bars, that's where we're actually looking currently. So you can see that that is completely reversed, and it was all self-inflicted in the US. If we move to the next slide, please. This is an interesting one, and I don't think many of you out there have seen something like this, but what this shows is oil intensity per unit of GDP. Back in the 1970s, the world was very reliant on oil for everything, whether it was production of goods and services or petrol, whatever it might be. The world was definitely more dependent on it. And what we've seen is over the years, new technologies, less reliance because more production locally. We've seen a drop-off of nearly 64% of reliance on oil. And so what that has meant is, even though this conflict in Iran seems scary to the rest of the world, which it is, the impact has been not as impactful as it would have been had we had a greater reliance on oil like we did back in the 1970s. We move to the next slide. This is just showing what happens after major conflicts. I think we have about 15 conflicts here. And what we see is the start of the conflict, where equities were at the end of 3 months, 1 year, and 3 years. After 3 years, there has not been any negative returns on equities. We see a couple in the 1 year area, but mostly the averages are at the very bottom. So this just basically goes to show that irrespective of what's happening in the market, it's always a good time to invest because you're going to most likely beat inflation. And that's really what everyone's trying to do when they invest and look to add to their retirement pot. We move to the next slide, please. Thank you. This is just showing what happens by putting money in the market and letting it grow versus what a lot of people do, putting money in the market, and when the market gets a little bit scary, getting out of the market and going to money markets and then going back in when they feel comfortable enough. The difference is staggering. 2% over a long term is a very huge differential when it comes to investing because compounding is so powerful 2% is going to be a large magnitude higher if you just stay in the market. And this is over a very long period. This is from 1990 through 2000, through the first month of 2026. So you've got a long pattern here, and you can see how it actually works out. So as we say, it's time in the market, not timing the market. If we move to the next slide, please.
Sorry, Mark, if I could also just add, the previous slide
Sure.
also kind of goes into reinforce what we talked about earlier. One, yes, what you mentioned, time in the market, not timing the market. And two, how you essentially need to tune out the noise. So there is a lot of sensationalizing news that's happening everywhere, which is supposed to obviously, kind of catch your attention. But when you have a plan and you stay disciplined to it and stay invested, this is what that differential is showing.
Yes. Thank you.
Thank you.
Okay, so this next one is, did we move to the, yeah. This next one is basically looking at the software stocks. Now, these have been impacted greatly by the AI movement because most of these investors believe that these companies can be replaced by AI and there won't be any more outsourcing. And right now, and I apologize for this because this is an older slide. This was from March of this year, I believe. They still are quite negative for the year. To give you an idea, at that point in time, Adobe was down 66% year to date. It's currently still down about 40%. So it's still a pretty significant decrease in valuation. And what we see is that at some point, is AI going to actually produce what it keeps talking about? Because obviously the capital expenditures on AI have been mind-numbing at the size of numbers that they're talking about. In data centers alone, they're talking about investing nearly $1 trillion. And if you know anything about construction, these things will not be built overnight. They take quite a long time to actually build. The problem is the equipment and the technology being put into those will most likely be outdated before the data centers are actually complete. And none of those figures are built into the prices that the big AI hyperscalers have been discussing. Okay, there's a difference between DCA and lump sum. Okay, so dollar cost averaging and lump sum is dollar cost averaging is you're putting it in almost whether it's weekly, monthly, quarterly, or something like that, and investing that way versus just putting the money in and investing everything at the same time. Now, there was a study done back in the late 90s, early aughts by a group called Vanguard. And I don't know if, I assume everyone's familiar with Vanguard. What they looked at was the difference between lump sum and dollar cost averaging or pound cost averaging, whatever country you're from. Basically, what it showed was that over the time frame that the study looked at, it was about 67% of the time lump sum outperformed dollar cost averaging. So that's what we believe in. We believe in putting in the market, especially if the money is coming from a sum that's already been invested. Okay, is there an outlook that these software stocks are going to recover? Again, I think that is very reliant on whether or not AI actually comes to fruition, because as of this time, it has not. We've got ChatGPT, we've got DeepSeek, we've got all of these different AI companies. I personally believe that those things are going to become commodities. So those will decline in price over time. But the AI hyperscalers and the data centers, are those going to prove to be something more what they are talking about and what investors are all excited about? We haven't seen it yet. No one has. And so until that actually happens, this is all basically riding the coattails of other investors and trying to get in on the game that hasn't actually materialized yet. Can we go to the next slide, please? Next one. So this is a view, I don't know if anyone's ever seen this, but this is a view of total global market cap. On the left-hand side, we see the US, which accounts for 62, but as of the end of yesterday was about 63%. What that means is 63% of the total market cap of the entire world is in the US. And by the way, of that, a majority of it is in 10 companies only. And so it's an odd thing to look at, but if you go to the right-hand side, you can see China. China is only 3% of global market cap. And what I've always told people when I pull this slide up is that if you go back in time to when I first started with MASECO, when I first saw one of these, the US was about 45%. And that was quite a long time ago now, unfortunately. But what we've seen is a huge outperformance in the US, especially from 2010 to 2025, that they've just beaten the rest of the world by basically 6.5% annually. If we go to the next slide, this is the story of diversification. What we see are different asset classes against each other and their performance annually from 2011 through the end of 2025 plus year-to-date 2026. That's at the end of July of 2026. So you can see, again, like Charu pointed out in the investment philosophy, there's no real pattern here. It's hard to determine what's going to do best next. And so what we have is a hypothetical 60-40 portfolio here in the white connecting. You're almost never going to have the highest return and you're almost never going to have the lowest return, but it's a diversified portfolio and a very good one. And if someone wanted to put together a portfolio, the easiest way to do it would be have 60% global equities and 40% global bonds. And that's a heck of a portfolio, and you will do well over time if you go into a portfolio like that. If we go to the next slide, please. This is just looking at the growth basically since 2021 of both growth stocks and value stocks. As you can see, there's been times of tremendous outperformance and underperformance, but basically value has kept along very well with growth stocks over this time frame. And as we mentioned already, value is one of the slants in our portfolio. Okay, someone wrote, you zoomed into performance of the software market over the last year. Do you have a suggestion on a particular industry worth investing in over the next year? Quantum computing, drone defense. I will say this, I expected defense to do a little better, but it was a short-lived thing. In fact, one of our clients was very interested in putting money into defense, and it turns out it's lagging. And I think part of that is because, especially in the European Union, they put a lot of money in at the start of 2025, but it's sort of petered out since then. And I'm not sure that we're going to see a tremendous output in or overachievement in defense that maybe we thought we would because of everyone jumped in at the start of the war in Iran and the lead up to it. If we can go to the next slide, please. This is just showing, again, this is one of those things talking about, do we invest now because the market is so frothy, should I go in? Well, what we see here is on the left-hand side, the light blue bars are at the start of a all-time high. And by the way, almost every single bear market started after an all-time high, but not every all-time high is followed by a bear market. And that's what you see here. On the right-hand side of each of these areas of the 1, 3, and 5 year is how the rest of the market has done over that time frame. So it's done fairly well. And we'll have another chart here shortly that talks into a bit more specific response to that. If we move to the next chart, please. And what we see here is, if you're not familiar, the Magnificent Seven is the 7 stocks that have led the entire market in the US for quite a number of years. Well, what we're seeing here is the actual underperformance of the Mag 7 over the past year or so. And what we see is the rest of the market has done well, but the Mag 7 have lagged. In fact, other than a couple of the Mag 7, all of them are underwater. And that trend will continue, is my expectations, because at this point in time, these companies are built for perfection, and that's what the expectations are for their earnings over the next quarter, next year, next 2 years. If they don't hit those markers, they're going to just take a beating, and I think that's what we'll see. And this, by the way, is not anything new. Over the lifetime of the stock market, those companies that have taken off and are the high flyers, there's always a point where they start falling and they tend to lag the market. And I think we'll see the same pattern here. If we move to the next slide, please.
Yes, if I could also just add in the previous slides, what Mark also just mentioned, the broader point essentially is that market leadership will rotate, and it does. So when you have your diversified portfolio, it allows you to participate when the returns broaden across sectors rather than relying heavily just on a small group of stocks. So, for example, just the Mag 7, rather than relying just on the Mag 7, you're essentially diversifying your portfolio and capturing the returns wherever they're occurring.
Thank you. So if we look at this one, and we put this one in because everyone had been talking about SpaceX, Anthropic, OpenAI. These are IPOs that one has already taken place, which was SpaceX. If any of my clients ever asked me about SpaceX, my response to them was that it's nothing more than a Ponzi scheme. And that's how it's turning out. It's down nearly 30% since its IPO. And that's a very, very short time for it to fall that much. It was always overinflated, and there was big promises without any backing at this point in time. And I think that's what we'll see to continue. But what this slide especially looks at is IPOs are very exciting. They're new, and everyone wants to get in on them. The reality is they do okay. They don't do phenomenally compared to what the rest of the market does. And that's what we're seeing here, is that the typical return from 1980 to 2024 of equities that are purchased via the IPO versus the rest of the market, you can see the difference in returns. And that has stayed, even though this time frame is pretty long, that's about 44 years, you can go back farther than this and you'll see the same type of numbers play out. If we move to the next slide, please. This is looking at regions and their overexposure to AI and all the tech. You can see the US is the big one there. But interestingly enough, EM is the reason why we have seen the returns in EM over the past year and a half, is because of their exposure to AI and all of the component parts. And what we're seeing is that at some point, 50% of the US market cap is tied to AI. That is not a sustainable position. And I believe that we'll see, as I was mentioning with the Mag 7, you'll see a drop off in returns based on that part of the market. We can move to the next slide, please. And one of the things that we see here are earnings. And I've talked about it at the very beginning, and I'll say it again. Earnings have been the fuel for this market rally, period. Even though a lot of people think it's very glum out there and very dour, the reality is returns are predicated on earnings, and if earnings are strong, you have a great market. And we have a great market because earnings are very strong. And you can see it here. The top line is EM. You can see the outperformance there. Then you have the US next, and then finally the rest of the world. So it's been a very good year for equities, and I expect that to continue until we see a fall off in terms of what the expectations are of the AI industry. We can move to the next slide, please. This is an interesting one. What we see here, and there's a lot to uncover here, but these are 12-month forward PEs, or price earning ratios. You can see the breakout of the areas below. The black bars themselves are the 25th to 75th percentile. The purple line is the 10th to the 90th percentile. The blue diamonds are where we are currently in terms of forward PEs, and the is that a orange, whatever that orange, I think it's orange diamond, was the start of 2026, what the expectations were. You can see the US are well above where they're supposed to be. And you see the value outside the US, and that will continue until we see an actual rotation, which is, it feels like it's starting already. It started in 2025, continuing in 2026, except for the Iran conflict. We move to the next slide, please. And then this is the forward PEs looking both developed markets as well as emerging markets. And if we take a look all the way on the right-hand side, you see the US and India leading the charge. India has been underperforming. US has been overperforming. And so this, again, was the start of 2026. And this is already turning out not to be accurate as most forecasts are.
If I could just
sure. You want to
give a
add
little
something?
clarity. So, Mark talked about the PE ratios in the previous slide and this one. So what essentially a PE ratio means is it tells you how expensive or cheap a stock is relative to the company's earnings. Yeah, just to kind of, add a little clarity there.
Yes. Okay, the next slide is looking at the PE of the top 10. So this is basically the Mag 7 plus a few different, a few other stocks versus the S&P 500 or the other 493 stocks, or 490 stocks. And the light green one is what the Mag 7 is. You can see it was beating the rest of the market. All of a sudden, it has had a dramatic fall off. Whereas you have the black line, which is the S&P 500, and then the light blue is the rest of the S&P 500 or the 490 stocks. Look at the convergence that we have seen in through July of this year. It has all come back down to the same thing. Whereas prior, you would see that the Mag 7 plus the other three have been outperforming the rest of the market, and it was the sole reason the markets performed so well. On the right panel, what we're looking at is the weight. And what we see is the black line represents the weight of the top 10 companies at almost 40%. At one point, these were at 44%. So it's if you take a look at an index is supposed to have no more than 10% of its components could be the greatest weight in the index. Otherwise, it becomes a non-diversified index. Well, the S&P 500 is a non-diversified index at this point in time because of the weight of only very few companies. However, we do see that the earnings of those 10 account for nearly 40% of all earnings in the S&P 500. So at this point in time, they are doing well, but if you actually look underneath the hood, you'll see that a lot of the 10 companies are just buying and selling amongst themselves. And once that cannibalism ends, I think you'll see their prices and earnings fall from there. If we move to the next slide, please. Next one. This is the same slide as we saw with equity market cap. This is fixed income, total fixed income. You can see the US here at 41, China at 10, and Japan at 8. What this is saying is that the US at 5% of total global population accounts for nearly 42% of the total debt in the world. Not a great position to be in. It's also one of the reasons that Trump has been caught on a number of occasions backing off of certain promises that he makes when he talks to the press. Because as the yields on the 10-year increase, it becomes more untenable for the U.S. to be able to pay that debt. And so he tends to back off. It happened with Greenland when he was threatening the EU, who, by the way, control almost $8 trillion of U.S. Debt and equities. They said that they were going to sell. He backed off. That was the reason for it. And so it's important to understand that the bond vigilantes have been the biggest check on his power since the start of his second term. If we move to the next slide, please. This is looking on the left-hand side, you've got the core sectors of fixed income. On the right-hand side, you've got the extended. The bars are 15 years of data. The blue diamond is, like before, is where we are currently. The purple is the average or the mean over that 15-year time horizon. So it's one of the reasons why we've seen a good return on fixed income, and I expect that will continue. To be fair, if we move post global financial crisis in 2009 going forward, rates were down to practically zero for quite a long time, and fixed income wasn't returning much. We're starting to see it as rates have ticked up. We're starting to finally see returns on fixed income, and I would expect that to continue. The U.S. is 41% of the global IG bond market. Is that concentration of risk for global bond investors or just a reflection of it means that the U.S. is very happy living in the debt world. They issue a lot of credit. When companies try to expand, they can do it a number of different ways. They can either borrow, which is what issuing bonds are, or you could sell stock. Stock becomes dilutive to the rest of the shareholders, so they will look at bonds and added an additional $4.5 trillion to debt in the U.S. just on his term alone, which is is an untenable situation. And I expect that at some point, the debt rating or the credit rating of the U.S. might get hit again. And if that happens, then the U.S. will find themselves in a place that they don't want to be in. If we can move to the next slide, please. The University of Michigan puts out something called the Consumer Sentiment Index. They've been doing this since the early 70s. The dotted line in the middle is the long-term average. If you're above that number, the economy and the participants feel comfortable with where the economy is headed. If you're below that, they don't feel that way. And you can see where we are currently on the very right-hand side. While we had a little bit of a bounce, and that was due because, if everyone remembers already, it seems like years ago, the MOU or the Memorandum of Understanding with Iran, which has already been basically killed. That was the reason why we saw that jump in consumer sentiment, is because petrol prices finally had started to come down below the $5 range, and people started feeling a little more confident. But the reality is we're right back to that level where we were. So I would imagine this next reading is going to be negative again. If we move to the next slide, please. This is just looking, we saw this one earlier in a different form. What this is showing is that how frequent are market corrections falling all-time highs. 1 year out, you have a 9% chance, 3 years 2, and 5 years 0. And because I think outside of AI, I think the biggest question is now the time to invest in the market. And almost every single piece of data that comes out says, yes, it's time to invest in the market if you're trying to beat inflation over the long term. You go to the next slide, please. I think we can skip this one. It's very similar to the last one. And then, so finally, here we are. Global equities have delivered strong gains so far. Market leadership continues to broaden, but I caution again, unless we start seeing returns and actual output of AI, I think that's a questionable part of the economy at this point in time. It has a feel, although this is my own personal belief, it has a feel very much of the late 90s going into the dot-com bomb. where you're having these inflated numbers come at you, and the numbers are staggering, and yet the output isn't there. We have a lot of companies laying people off. AI is going to change a lot of things, I think, over time. It's not going to change everything. And I don't think it will replace everyone, much like someone like a Musk or Peter Thiel have been saying. I don't see that happening. Just like when we had the internet, everyone thought that certain sectors would go away completely. What we see is that people have retrained, and I think that's what we will see with the AI movement as well. Major central banks remain cautious. I think that, as I stated, most of the rest of the world are either on hold or looking to raise. And I think that the US will definitely have no option but raising rates by the end of this year, at least 1 to 2 times. Labor markets have been softening. Consumer spending has been softening. And that's only because of the elevated levels of prices out there. And if the tariffs continue, that's just a bolt-on, which will detract from GDP over the short and medium term. That is our global market update. I guess I can open it up for questions.
And Mark, I have a question. So, in your opinion, and just mirroring what's happening in South Korea right now, in your opinion, do you feel we have an AI bubble?
As in my estimation, is it a bubble? Yeah, I think it's a bubble. But the problem is when you try to guess when that bubble is going to pop, you tend to lose. So you ride it until you're not riding it. But as Charu mentioned, for us, for our firm, we're globally diversified. Do we have those AI stocks? 100% we have those AI stocks, but we also have nearly 16,000 other ones. And so we don't try to focus on just what's happening. When SpaceX was getting ready to IPO, a few of the major indexes changed their rules to accommodate them. Fortunately, some of the bigger ones did not, like the S&P 500 did not change their rules for listing on the S&P 500. And as of this call, the MASECO does not have SpaceX in any of their portfolios.
I see. And then another one on my end, Mark, sorry. So you've mentioned all-time high and emotional crash. Do you foresee a recession coming in the US?
Can you repeat that?
So as mentioned, usually it's an all-time high, then emotional. Do you foresee an economic recession coming in the near future?
I see a correction? 100%. I see a correction. However, I say that tongue in cheek because the market's always going to have a correction. And trying to time when that correction is going to happen, don't know. We've already had a mini one toward the beginning of this year where we saw a 10% movement down from the all-time high. Those will happen. Those are healthy for the market. But that doesn't mean you get out of the market. What that means is you just hold on, and it's a movement of the market. The same question I would pose to someone when they talk about their fear of market falls is, okay, and if the market goes up 10%, are you going to sell out because you got the 10% return? No. You're going to just let it ride, and that's what's going to happen. And that's why it's time in the market, not timing the market.
And then will it cause a recession?
Say again?
Do you think it will cause a recession?
My expectation for the U.S., yes, I do see a recession in the future. However, remember, technically, a recession is nothing more than 2 consecutive quarters of negative GDP. That's all a recession means. Wade?
Yeah, I had a quick question. What is there an issue or that you could quickly describe that maybe some or most of your clients are struggling with, or that you're helping them out with?
Well, it's always taxes. It's always taxes, but nothing from an investment standpoint per se. They're all diversified. They're all pretty happy with where they are. Most everyone is assuming the same level of risk that they did at the start of the year. In fact, every single one of our clients is holding on to the same level of risk in their individual portfolios. So, outside of the guess of when the Iran war is going to end, which, by the way, is going to, in my estimation, is going to end up being a loss for the U.S. because there's no way they can protect that Strait of Hormuz. They're going to give up everything that they actually had prior to the start of the conflict.
Just to add on to that, to your question, so a lot of the new clients that come to us, prospects, and then they then want to work with us, a lot of them would come to us with portfolios that are heavily concentrated into specific geographies or with very little diversification. So yes, that's one thing that they would look at. The second thing would be the costs. So a lot of them would come with very high underlying costs. A lot of times those costs are hidden, which means as an investor, you are not completely aware of the costs that you are incurring on your portfolios. You essentially see that reflected in the returns. So typically it would be lower cost, more diversification, less concentration.
I have another question here. Someone says, if Mustafa says, if someone is holding on to a large sum of cash right now, do you recommend they invest it right away or hold off to buy, then hold afterwards, given the AI bubble and pending correction? As I've mentioned multiple times, yes, I believe the time to invest is right now. If you had said to anyone before the start of the Iran conflict, would you believe that the markets would be up 42% year to date? Probably not. The same thing is true in the early part of 1999. Would you say that these valuations were so ridiculously high? Should you invest now because it's clearly a bubble? Probably not. Yet 1999 was a fabulous year for equities, just like 2026 has been so far.
Okay, there's another question.
Are there any areas of the global market where you currently feel investors are being particularly well compensated for the risk they're taking? Yes, emerging markets by a long shot. Emerging markets has been the star for the past 18 months, and it will continue to do so. It is unfortunately heavily concentrated because of the AI spend in Korea and Taiwan, but it's still a great area of the market where people are being handsomely compensated for their risk.
All right. Well, Mark and Charo, I want to thank you. I know we're running short of time, and I just want to tell the audience here that I've known Mark and Charu for quite a bit now, and besides their technical and knowledge and a broad knowledge on financial markets, they also know quite a bit about other financial products, life insurance, private equity, and all these other types of products. And what's most important to me that I've recognized from them is that they're very well connected in the Hong Kong market, especially. And when you're choosing a financial advisor, it's one thing to have someone that knows how to allocate your investments properly and understand your risk tolerance. But another important thing is their relationships with other banks and with other people that you may never know when you might need assistance with something else. So if you have any interest in speaking with MASECO, we have the information here on the slides, or you can reach out to any one of us and we'll get you to the right person. So thank you very much.
Thank you
for attending our seminar.
Thank you.
We'd love to have MASECO back at some point.
Sounds great. Thank you for allowing us to speak today.
Thank you.
All right.
Thank you. Bye-bye.
Bye.
Bye-bye.